Hello and a very warm welcome to Econoday Unplugged. It's Tuesday, the 6th of February 2024, and on today's podcast we have Terry Sheehan on the US East Coast, Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London. So far in 2024 then, all of the major central banks have resisted pressure in financial markets for an early reduction in interest rates. Only yesterday, the OECD called on global monetary authorities to be certain that they had beaten inflation before pulling the rate cut trigger. Well, last week, the IMF, having just revised stronger its 2024 global growth forecast and talked up the prospects of a soft landing, said that there'll be a greater risk to economic stability should the bank cuts too soon rather than a little too late. In the main, inflation is still falling, but the policy pushback has become more vocal in a number of countries amid signs that some prices remain uncomfortably sticky. Recent developments in the Red Sea, of course, also pose an upside threat. So given all of that, just how long might it be before key interest rates finally start to come down? So Terry, to you first then, a steady Fed last week. And I guess when it comes to pushback, it would seem pretty fair to say that Powell did a good job.
Yes, indeed, he did. I think there's still a lot of sentiment out there that people are looking for a rate cut sooner, but the chair and other Fed policymakers since then have been pretty consistent in the message that, yes, they're happy about the progress with inflation so far, but they want to be more confident. And I think overall the outlook can be described as hawkishly optimistic.
Okay, is a March cut now completely off the table, do you think, or there still a possibility of that?
Well, any decision is never completely off the table, but I do think that March would be far too soon to look for one.
All right. Let me ask you about the employment numbers back end of last week. If I wrote my figures down correctly here, 353,000 new jobs, more than double the consensus, well above the average we saw throughout 2023 as a whole. December revised up. Isn't it the case that the US economy is almost booming?
You would think that based on those numbers, but really a lot of it is that there have been a lot of job openings around for a long time that businesses have been unable to fill, but we've seen enough easing in the labor market supply that some of those jobs are getting filled now.
Unemployment rate. I mean, how important is this to the FOMC now? I'm not held steady, well, 3.7%, but is expected to go up to 3.8%. Wage growth also, that accelerated. What I think we're at 4.5% now. I mean, is it becoming increasingly difficult, do you think, for the FOMC to actually sell the idea that interest rates need to be cut in the first place?
Well, I do think that the Fed has its dual mandate, and although they are making steady progress toward the price stability side of it, they may be looking at the maximum employment side of it and saying they don't want to lower rates because they don't want to stimulate the economy at this point. We don't have, a lot of give in the labor supply, even with the recent improvement in it.
Okay, well, I know you're sort of, well, I won't say a fan of, but I know you certainly look at the now forecast for economic growth in the States. What's early days yet? Clearly, we only just started into February, but what are they saying about first quarter US growth?
Well, it's very limited, but in terms of data, but it's looking north of 2%, which is above the Fed's longer run forecast. So we're actually looking at what might be a surprisingly strong first quarter. Frequently, the GDP data for the US puts the first quarter in sort of a weaker position compared to the quarters around it. But it's not looking like that's going to be the case, at least at this very early stage.
So let me ask you then, let's suppose we get first quarter growth of, I don't know, given how, as you say, I mean, it is very early days. Let's suppose we come in somewhere around about 3%, and the inflation numbers sort of settle down a bit or perhaps dribble down a little bit more. I mean, do you think we're going to get to the stage whereby the UFM does start to believe, well, look, any rate cuts this year have got to be really quite limited, simply because the economy is performing well enough that the pressure on the Fed to cut rates just simply isn't there anymore?
Well, I think the economic pressure certainly won't be as much. I mean, if the economy keeps performing at this level with rates at where they are, it probably says that rates are about where they should be. Now, political pressure may be an entirely different thing in a presidential election year.
And which way do you think? I mean, there's clearly some talks that Powell might want to deliver an interest rate cut ahead of the elections. Do you think yourself that the elections themselves really have any impact on what the FOMC might do?
I think they will make their decisions based on the economic data. I mean, they might have personal opinions where they would like to see something that would favor whomever they do in the political spectrum. But on the whole, I would say Fed policymakers are very careful to stay above the political fray. And in his press briefing last week, they were always ready asking him if he would be willing to take another term, or if he thought that he would get another term if Trump was president, and he just avoided making any real response to that, because I think the Fed has to be very careful about their public perceptions of their political neutrality. And I think the facts of it are pretty clear too.
Okay, fair enough. I guess it's true. All central banks, isn't it? Independence is key if they're going to their policies are going to have any credibility at all. So, all right. I mean, my last question to you then. In terms of looking at financial markets, if I've got my futures numbers right, I mean, they're still pricing in about 25 basis point cuts this year, and that compares what the Fed's talking about 3. So, who's right?
I think it's more likely the Fed's right. Now, one of the things that's kind of conditional on is we will be getting revisions to our consumer price index data on Friday. And last year at this time, when we got those revisions, they were less favorable about the progress made in bringing down inflation. So another upside surprise in the revisions would definitely put the Fed on, or keep the Fed on the path of holding rates and fewer rate cuts.
So go on then, I've got to ask you, when's your call on when the first cut comes through?
June.
Okay, fair enough. Anything else from your side, Terry?
No.
Okay.
That's it for the moment.
Okay, that's great. Thank you, as always, very much for that. Sadly, we don't have Maxato here today. He's busy at this very moment, scribbling away about the Bank of Canada. So I'll quickly filling him with some of the comments he's already sent across to me. Where are we in terms of the Bank of Canada? Well, clearly they were another of the major central banks holding policy steady in January. So with their benchmark overnight target rate left at 5.0%, and indeed it's been there since July 2023. In terms of the economy and what that means for the BOC, well, November GDP turned out surprisingly strong. Their monthly figure put it up 0.2%, and that was certainly better than the market expected. It also means that absent any revisions, the December data would need to see a decline of at least 0.6% in GDP on the month if we're going to see a negative handle on fourth quarter G, and that's fourth quarter GDP. And that certainly seems pretty unlikely, especially since we got the stats guys out there currently forecasting a rise of 0.3%. So all in all, it looks almost certain now, but at least for the time being anyway, Canada has avoided a recession. The third quarter number was much weaker than expected, down 1.1% at a season-adjusted annualized rate. And of course, that may well mean that perhaps there's a little bit less pressure on the Bank of Canada itself for a near-term cut in interest rates. Anyway, I guess for the BOC anyway, the main focus seems to be not so much perhaps on the GDP numbers as on what's going on with the labour market and particularly the degree of slack in that market. This Friday, we'll get the employment figures, which are obviously always important as ever. December, we saw payrolls up, just 100, so essentially just flat. For January, the consensus is mixed. Employment seemed up a much stronger 14,500, but the unemployment rate is also expected to move up to 5.9% from 5.8%, so kind of something for everyone there. I guess the key in many ways is still watching the weekly average earnings figures. They jumped up to 4.1% year on year in the November data, and that was a 4-month high. And we know that the Bank of Canada is still worried about what people these days call persistence in underlying inflation, particularly with regards to services. And with wage growth clearly still high, now they remain a little bit concerned about declaring victory on getting inflation down too soon. All that said, from the January policy meeting, the bank did indicate that it's shifted its stance from whether rates are high enough to how long rates need to remain at current levels. So it may not be a major move, but it's certainly a hint of a shift in a more dovish direction, which is going to open the door to easing later in the year. So pull all that little lot together, and what do we got? Well, March, I suspect, is a little bit too early in terms of any real possibility of an interest rate cut, and quite likely that applies to April as well. So June perhaps still remains at this time anyway as the most likely date for when we do see the first cut coming out there. Okay, to Asia then. Bank of Japan, well, I suppose really there's not too much addition to add to the Bank of Japan stance from what Max has said in previous podcasts. They're still really waiting on what's going to come out of the wage negotiations currently taking place. And given we won't get those for a couple of months or so yet at least, that means almost certainly that March is a non-starter in terms of the BOJ hiking interest rates. Of course, in a number of countries in Asia, we're looking at higher rates rather than lower rates. April, though, certainly remains a realistic possibility, and so long as the wages news is relatively favourable and inflation, of course, comes in as the BOJ is sort of expecting. The 26th of April meeting, when the Bank of Japan will also be issuing some new forecasts for fiscal 2026. So from that, we'll get an idea of their long-term view of inflation might be headed. That might be just about the first realistic opportunity that we could see the BOJ finally come out and begin the tightening shift in its policy that so many people have been looking at for so long. Okay, so BOJ may be moving towards raising interest rates to Brian and China, where things, if anything, seem to be going the other way. So, Brian, I mean, Evergrande back in the headlines for all the wrong reasons. We've had the central bank unusually pre-announcing yesterday's cut in bank reserve requirements. And that, I think, if I got it right, was the largest cut since the end of 2021. Of course, the stock market has been all over the place, hitting a 5-year low in January. So, I mean, how bad are things in China at the moment? Hello, Brian. Hello, Terry.
Oh, sorry about that. I'm back on. Can you hear me now?
Yeah, sure. Okay, obviously had the problems with communications. Yeah, please, Brian, you're on.
Sorry about that. No, I think you're right. The news about Evergrande when it broke, late last month, just definitely highlighted the ongoing issues that the property market is causing in China. It's been sort of the main drag on the economy for going on 18 months now at least. So there was some sort of speculation that there'd be a bit of reaction to that. And there could be some more down the track. It's sort of the interesting time of the year in China where we sort of go dark on incoming data because of the impact of the Lunar New Year holiday. So we won't get as most people know, we don't get separate data for January and February at the start of the year. They sort of bunch them together and release them in March. So we're not going to get a lot of data over the next few weeks, and so we sort of have to try and figure out what is going to happen based on very limited information. Also, next month we'll have the National People's Congress. That's where the China's leadership normally do make announcements about any changes to policy or any sort of broader changes, and also set their economic forecasts for the year. So we're in a little bit of a holding pattern at the moment.
I've got to ask you about this sort of semi-collapse in the stock market at a time when a lot of the other major European markets and obviously US market have been moving up. The S&P's been hitting all-time record highs. We've had similar kind of levels coming out of a number of European bourses as well. And yet we've seen these Chinese markets moving down amid signs that there have been some perhaps significant capital outflows from China. To some extent, it seems going into the likes of India. How concerned do you think the authorities in China are about what's happening in terms of international investment now?
Yeah, that's definitely you're hearing more noise about that. I think it turned sort of sometime last year where you started to see much slower inflows, and now we're sort of starting to see outflows as well. And I do think that's a recognition of the Chinese economy has just been really sluggish for a long time now. We had the pandemic, we had the COVID zero impact, we had sort of measures to try and to recover from that, which didn't really get momentum, and we've had this ongoing slowdown in the property market. So there hasn't been really a lot of positive news coming out of the Chinese economy to make foreign investors excited. And in contrast, there definitely is, I think, more optimism about the situation in India at the moment. They've had reasonably solid growth and a lot more stable outlook, I think. So that's definitely going to be an issue that's people in Beijing are thinking about, and we might, as I said, at the NPC meetings next month, we might hear a bit of talk about what can be done to try and get China back in favour with foreign investors.
Okay, well, I guess since we've been talking about interest rate moves or prospective interest rate moves from central banks, we've had this move, the latest move on banks' reserve requirements. What chance do you think there is of actually coming out and cutting long-term prime rate? Is it the case that they need to do something now to underpin the stock market, or is it the case that by cutting interest rates they're going to undermine the currency further, so you get a further move coming out in terms of capital on that? What do you think that they're really thinking about doing now to try and reassure investor confidence?
Well, I think you've identified the issues with making a move in either direction, and it's a bit of a dilemma for them at the moment. Their preference, I think, will be to try and ride this out and tweak it here and there with reserve requirements rather than, but not putting in a huge shift in monetary policy settings. Mm-hmm. They would prefer, I think, to not have to do that, but events and circumstances might force their hand. As I said, it's a little bit difficult at the moment to know exactly what they might be thinking with the lack of data that they're going to be having in the next few weeks. They'll see, obviously, other indicators, and we'll be getting reports about how they think things are going. But from the outside, it's hard for us to get a handle of it, given just how opaque their communication is, and the fact that we're not seeing a lot of data at the moment as well. If you look at the PMI surveys that we had over the last week or so, they're nothing to write home about. Still showing pretty subdued conditions in the services sector, and either contraction or very slow growth in the manufacturing sector. So, there's definitely the case there for some policy measures to support demand and activity, but there's other constraints and variables that they have to take into it.
Oh, interesting times. Watch this space, as they say. All right, let's shift across to your immediate part of the world down in Australia. RBA last night, no change, which I guess was no surprise to really anyone. But were there any hints in the accompanying sort of the forecasts and the statements as to when we might see anything coming out of the RBA?
I mean, it's interesting. As people might know, the RBA has changed its sort of communication and also the scheduling of its meetings. It used to meet pretty much every month of the year except for January. Now it's meeting every 6 or so weeks, and so the idea behind that was to allow for more research and analysis in the lead up to the meetings, and they've also trying to improve their communication of their thinking to people, and also not just professionals and investors, but also to the general public.
Mm-hmm.
So it was quite striking. If you have a look at the quarterly monetary policy statement that came out with the decision yesterday, it's a lot more user friendly, a lot more clearly directed at the general public, trying to get them to understand what the RBA is thinking and why they're doing what they're doing. So that's interesting. And the other big innovation is that we're now having a media conference straight after the meeting. So we had the new governor, Michelle Bullock, come out and give her first media conference after yesterday's decision. And so that was interesting. You had obviously journalists asking sort of gotcha questions and trying to really nail down to when people can expect their mortgage rates to go down. Mm-hmm. And Governor Bullock was pretty non-committal about what is going to be happening with policy rates. She says we're not ruling anything in, we're not ruling anything out. And what you'd expect a central bank official to say, that it's going to depend on the data and it's going to depend on how we see inflation tracking and making no promises, etc., etc. So she obviously was limited in what she could say, but it was definitely an attempt to build communication.
Okay, fair enough. I guess just last thing on Aussie, I suppose for a while now, most investors have been talking about no cut in interest rates, RBA interest rates, until the second half of this year. I mean, is that still the most likely call, do you think?
Yeah, I mean, we definitely saw more chances of a rate being priced in after we had the inflation numbers a few days ago. So we had both the quarterly and the monthly inflation mm-hmm. numbers show that towards the end of last year, there was definitely a reduction in price pressures. So that's exactly obviously what the RBA wants to see. And so that was immediately reflected in financial markets pricing in a greater chance of some rate cuts this year. And, if we see that trend continue, then definitely it comes into play. As I said, Governor Bullock didn't want to commit to that, but she's made it clear that that's definitely an option if the numbers go in that direction. So I think we're definitely seeing a lot of political pressure coming on the RBA, but they're used to that, and I don't think that will be a huge factor for them going forward. But we are seeing the numbers starting to turn in the direction that would allow that to be considered.
Okay, New Zealand then. Well, I guess it's a similar sort of story there, but you can update us on that. But from what I've seen, it seems as if inflation clearly is coming down now, but a chunk of that's got to do with cooling overseas pressures and domestic price pressures, if anything, still remain quite strong. Is that a fair point? In which case, perhaps we can't really expect any move by the RBNZ.
I don't. Their next meeting is later in the month, and I wouldn't expect to move then. But it's a similar situation to the RBA. If that positive, if the trend continues in that direction, I think it will open up the door for that to be considered at least. But the RBNZ, we're again in a pretty interesting time of the year for them as well. They had their last meeting way back at the end of November, and They won't be again until at the end of February. So they have this sort of 3-month holiday over the southern summer where you don't hear a lot of news from them. You don't really get a lot of indication on what they're thinking, and so until we actually do have that meeting later on this month to get an update on their forecasts and what they're thinking about the outlook, we're a little bit blind on what's going on in.
Can I ask you on that? Sorry, just rudely interrupting. Can I ask you on that? Because it's quite unusual, such a big gap between central bank meetings. Looking at, most of the majors, they pretty all had December meetings in 2023. So, is it always a case the RBNZ has such a big gap? And is there any particular reason why they might leave such a big gap between policy decisions?
No, it's a common. It's what they do. They normally have, I think, about 7 meetings in the year, and it just so happens that over the new year, that's when they have their big break. Obviously they're not asleep at the wheel. They're still monitoring things and analysing things, but My suspicion is that is when a lot of the senior officials, take a bit of time off, then you don't hear from them. So, that's not to say that obviously if important events happen or really significant data come out that you wouldn't get a response from the RBNZ, but it is very common. It is the standard practice to have that sort of big break from November to February.
Interesting. Right, my last question for you then, apart from anything else you might want to put into the pot anyway. South Korea, I guess it's no great surprise, but the central bank governor, I think, made a comment last week to the effect that delays in the South Korean central bank interest rate cuts, they could be delayed if we do see a slower pace of interest rate reductions coming out of the US. I suppose that kind of underlines the importance of what Fed policy means for that part of the world. And is that a general statement we can stick with? Is it a lot of other countries actually looking to see what the Fed's going to do before they kind of think happy about perhaps moving in the same direction?
Oh, certainly, yeah. That's always a big factor right across the region. They're always, obviously focused on what interest rate differentials could do to the exchange rate and their export competitiveness, and just there is definitely a tendency to keep a very close eye on what the Fed's doing. That's certainly true. Of South Korea, Taiwan, and other big exporters, but right across the region, that's very common. Okay.
Anything else from your side, Brian?
No, we have the RBI later this week, so I guess we'll probably have to wait until they speak to get an update on what's going on. I think right now the biggest issue in India is the cricket against England, but when we see the RBI statement, that'll be interesting to see if there's any update to what they're thinking. I think the focus still is very much on upside risks to inflation in India because the growth numbers have been pretty solid. So I don't think that they're too worried at the moment about what the level of policy rates is doing to demand and activity in India. So for at least the short term, I think the inflation is still going to be the big focus.
Okay, excellent. Thank you very much for that. And certainly it would seem to be safe to say that the current level of RBI interest rates isn't affecting the cricket because the Indians won the last test match against us. But let's move on from that to Europe then. What can you say about Europe? Well, traders in Europe, like I guess around most of the other major countries, they've trimmed their interest rate cut expectations over the course of the last month or so. In terms of the ECB, back end of last year, investors, or at least the futures markets, were looking for around about 7 25 basis point cuts during the course of 2024. And even though that's been trimmed, it's still as many as 5 25 basis point reductions. So if anything, markets are still well ahead of what the ECB kind of intimates it wants to see during the course of a year. Other banks in the area, well, the Bank of England, that's now expected, according to financial markets, to reduce rates about 3 times, 25 basis points, compared to what best part of 5 interest rate cuts expected at the same time back end of last year. So we have seen some moderation in rate cut speculation, but it's still very much in there. And it's something that both the likes of the Bank of England and the ECB have been pushing against over the course of recent weeks. And I guess we can say certainly that in terms of rate cut speculation, that's reflected in where the bond market's been performing over here. We've seen very heavy demand at recent bond auctions out of most of the European countries as investors look to try to lock in what they at least believe will be very attractive rates indeed. Last week we saw record demand at auctions, bond auctions in both Germany and in Greece as well. The fact that Greece is doing so well is an indication of the lack of pressures at the moment in terms of financial stability within the European currency system. For the ECB itself, it's still all about inflation. And for January, the inflation numbers were good and I guess not so good. The headline numbers and indeed the core numbers are still coming down. So headline for January was 2.8 down from 2.9. The core was 3.3 after 3.4. Both though as expected. But the good news is on the core is it's been declining every month since last July. However, And this is something which is becoming increasingly important, I think, particularly for the European central banks. The services side of the economy, the inflation rate there was sticky at 4.0% for the third successive months. So that, in other words, is still double the ECB's target. And it really does reflect the increasing importance of the contribution of the domestic components to inflation versus what's going on overseas, particularly obviously with energy prices have come down so sharply. In terms of services, it's worth pointing out that's about 45% of the overall consumer price basket. So what happens to domestic services is going to have a big say in what happens to inflation. So it's very much a factor that the ECB is looking at the moment and will be a key determinant in terms of when they finally come out and cut interest rates. The economy itself, well, I guess hasn't had too many surprises of late. The purchasing managers and other surveys suggest that it's still sort of skirting with recession. It's not technically in recession at the moment, but it's not far off. However, and again, this is another reason for being a little bit cautious about how quickly interest rates will be cut. The labour market remains remarkably tight. The unemployment rate for December, that was 6.4%, which may be a bit higher than some countries, but by Eurozone standards, that equals its all-time low. So it's still a major issue for especially the hawks on the ECB's governing council, with wage negotiations across much of the region still underway. Put all that little lot together, then it's still probably the best bet that we won't see a cut in ECB interest rates in March. April, some people are talking about, but I kind of wonder if that might be a bit too early as well. June, if anything, is probably rather more likely. And I guess I should mention, just out of interest, for the first time ever, I think, the ECB last week reported on its artificial intelligence model, its AI model of inflation. And that showed Eurozone inflation could fall quite a lot faster than the central bank itself is expecting during the course of this year. However, as the bank's chief economist, Philip Lane, was keen to point out, there's an awful lot of uncertainty surrounding that. So at this stage, presumably, they're not attached too much weight to it. But with AI increasingly one of the great talks about markets and indeed all aspects of the economy at the moment, may be something worthwhile keeping an eye on as we go through the rest of the year. Bank of England then, well, I think it's fair to say that the old B of E is still grappling with how the economy in general and the labour market in particular are performing. Last week, that was reflected in the bank's Monetary Policy Committee vote, which saw a three-way split. So we had 6 members wanting to leave policy on hold, so bank rate at 5.25%. A couple still of the hawks wanting another 25 basis point increase, and one, Sweated Agri, who is the main dove, actually wanting now to come out and cut interest rates by 25 basis points. So I guess it put a straight line through that little lot. It suggests a slightly more dovish shift by the policy, but hardly indicative of any kind of early interest rate cut. Indeed, at this stage, so the fact we still have some members wanting to see rates going up kind of suggests that a very early cut anyway is certainly off the board. Now, last week in its minutes, the Bank of England hinted that it thought there might have been some easing in the labour market, which is still one of its key market variables to watch. As we talked about on previous podcasts, the Official Statistics Office here has struggled with the labour market data over the last several months. But as of next week, they'll be releasing some new figures using hopefully improved sampling survey, which should give a better impression or more accurate impression of what's actually going on. Now, they came out with some initial estimates yesterday of some of the back figures. And the bottom line there was, again, if you take it at face value, it suggested that the UK unemployment rate was 3.9% in the 3 months to November. Now, that's down from the 4.2%, which the official data previously estimated by their so-called temporary experimental statistics. So in other words, both historically speaking, the labour market remains very tight, and also, particularly from Bank of England perspective, it's tighter than they originally thought it was. So that could well mean, again, there was that much more reason for supposing that the bank's going to be a little bit cautious about how rapidly it wants to reduce borrowing costs. All that said, of course, as we've seen in the UK, along with so many other industrialised countries, relationship between what's going on in the labour market, what's going on with wages and inflation still seems to be a little bit uneven at the moment. And so a lot of these models really don't work as well as they should do. For the doves, though, I should mention that we had some comments coming out of Hugh Pill yesterday. He's the Bank of England's chief economist. And he said that we don't need to see underlying inflation, and that was 5.1% in December, get back to the 2% target in order to begin to reduce bank rate because we're at a restrictive level. Now, I guess Pill can be seen as a reasonably decent litmus test of what the majority of the Bank of England MPC is going to be doing over the course of coming months. The fact he's come out and suggested that, bottom line is we don't need core inflation at the target level before they cut interest rates is going to get some people thinking, well, hang about, as long as we see some fairly decent reductions in the rate over the next couple of months or so, we could be in the right kind of ballpark for bank rate to be restricted. So I think there's going to be a number of factors clearly influencing market sentiment over the course of the next few months. But, the core CPI and how it's coming down is certainly going to be one of them. For Joyce, though, it still seems to me unlikely we're going to see a cut in bank rate in the UK, probably until at least June type time. It could be we see something before then, because headline inflation is certainly going to come down. So politically, there's going to be a lot of pressure on them. And of course, we do have the prospect of a general election, well, almost certainly before the back end of this year. But the bank, I think, it's going to want to play safe to make sure and get inflation, which is still so far above target in the first place, back down to where it should be, or at least very close to where it should be before it finally acts. Round off my side then with Europe, with the Switzerland. Swiss National Bank favoured by some as a main contender to be amongst the first to cut interest rates. The next monetary policy assessment by the Swiss National Bank is on the 21st of March, so that'll be the same date as the next Bank of England meeting. But the chair, Thomas Jordan's recently warned that the Swiss franc has been appreciating real terms, so putting downside pressure on the real economy. VAT went up last month, and electricity prices will be at least slightly higher during 2024. However, despite that, Jordan came out and said that inflation, although it's likely to go up again, it shouldn't go back above 2%. And he also said that the situation was significantly better and, to quote, looks pretty good. Now, by Jordan's standards, that's really quite dovish. So I think, looking ahead, financial markets can start thinking that the SNB could well be amongst the first to cut, and it could come as early as March. Certainly, if we get some good inflation numbers in the interim, then it may well be that we'll see the Swiss National Bank finally coming out and adopting a slightly more dovish approach to policy rather than amongst the most hawkish that we've seen across the region. Okay, then. Well, that is probably enough then as far as this edition of the podcast is concerned. In sum, well, what can we say? Interest rates are certainly coming down around much of the globe, but in many cases, not just yet. And central banks in general, well, they're going to be determined not to jeopardise the hard-won victories against inflation that they've secured to date. That said, inflation remains the key, so keep up to date with what's going on there, and of course, all the other key economic data and events in Econoday's global economic calendar. On behalf of Terry, Brahmi, thanks as ever for tuning in, and we'll all be back again soon. Bye for now.